The great lie about economic crashes is that they are random disasters. They are not random for the people who get richer in them. For them, a crash is not mainly a tragedy. It is a transfer. That is the difference between the public story and the private one. The public story says crashes are unpredictable. Diversification is the only shield. And the best ordinary person can do is endure the damage with dignity and wait years for the market to heal. The private story, the one visible in filings, in acquisition records, in auction flow, in private balance sheet behavior, says something colder. The wealthiest people do not primarily react to crashes. They prepare for them, not by predicting the exact week, not by screaming apocalypse on television, not by making theatrical all or nothing bets. They prepare by quietly accumulating the kinds of assets that become more powerful when other people lose options. That is the mother line I want you to hold all the way through this story. The rich do not make their greatest money by forecasting panic. They make it by owning liquidity, legal priority, productive scarcity, and essential cash flow before panic turns those things into weapons. That is the line. Not courage alone, not contrarian slogans, not financial cleverness, in the shallow sense positioning. Because when markets break, the visible story is always fear. Screens go red, headlines become shrill. People talk about recession, contagion, crisis, collapse. But underneath that spectacle, something much older and much more mechanical is taking place. Weak hands are being forced to sell. Assets are being repriced under stress. Ownership is changing at terms that would have been impossible in calm conditions. That is what the sophisticated buyer waits for, and he can only wait for it if he spent the previous 18 to 24 months building the right structure. That is what most people miss. They want to know what to buy during the crash. The real money already asked that question before the crash. Now let me show you the mechanisms. The first mechanism is liquidity ammunition. This is the most boring asset on the list, and that is exactly why it matters so much. Before major dislocations, the wealthiest allocators do not usually begin by chasing the glamorous hedge. They begin by increasing their ability to buy later. They accumulate short-duration sovereign paper, treasury bills, near cash equivalents, boring instruments that do almost nothing except one precious job. They survive intact. That sounds trivial until you understand the mathematics of a crash. If stocks fall 50%, if corporate bonds break, if real estate becomes illiquid, then the investor who preserved liquidity is not simply the person who avoided losses. He is the only person in the room with a wallet still full when every extraordinary asset is suddenly on sale. That is liquidity ammunition. Most ordinary investors experience cash as an emotional burden. They think cash is laziness. They think it is underperformance in waiting. They think holding it means missing the upside. While the market still levitates, the institutional mind thinks differently. Cash is not there to make you feel efficient. It is there to make sure you can transact when others cannot. That is a completely different role. A crash requires forced sellers. Forced sellers require buyers. Buyers require cash. Everything follows from that. This is why I have always respected the investor who can sit in short paper without embarrassment. He is not hiding. He is loading the weapon that only becomes visible when the window finally opens. Now let us move to the second mechanism. I call it legal priority. When an ordinary investor thinks about a failing company, he thinks in terms of stock price. That is already too late and too shallow. Sophisticated capital looks at the same collapsing company and asks a different question. Who sits highest in the legal waterfall when the body hits the ground? That is how distressed debt works. A bankrupt company looks like a corpse to the public, to the specialist. It is an ownership puzzle. Its bonds may trade at 15 cents on the dollar, 20 cents, sometimes less. The market prices them as if they are nearly worthless because fear has no time for legal nuance. But bankruptcy is not only destruction. It is also reallocation through a court-managed hierarchy. Senior secured creditors sit above junior creditors, bondholders sit above equity, and common shareholders, the people still imagining they own something because the ticker exists, often get nothing at all. That is the brutality of legal priority. The distressed debt buyer does not purchase the stock of a troubled business because he does not want to share the fate of the public shareholder. He purchases the obligation, he buys the legal claim that outranks everyone else beneath it. If the company restructures, the old equity gets wiped out and the debt holder often emerges holding the new equity in the reorganized company. He did not buy a trade. He bought his way into the cap table through the law. That is one of the cleanest wealth transfer mechanisms in modern finance, and most ordinary people never even see it. They think the company went bankrupt. They do not understand that bankruptcy is also a gate through which assets travel from public owners to capital with legal priority and patience. That is not an accident. It is how the architecture works. Now let us move to the third mechanism. I call it productive scarcity. Some assets do not derive their value from optimism. Growth narratives or the current mood of financial markets, they derive it from biological necessity. The cleanest example is productive agricultural land. I do not mean land as a romantic symbol. I mean acreage that grows food, that throws off real output. That sits underneath calories human beings still require, regardless of whether the SP is expensive, the banking system is stressed, or the currency is melting. That is productive scarcity. Farmland has a floor under it that many glamorous assets do not. People can delay buying a car, they can cancel a streaming service, they can postpone a vacation. They do not opt out of eating because credit spreads widened. That is why serious buyers have always moved toward productive land during periods of monetary distrust and financial dislocation. The land itself matters. But the real magic is what the land produces. Food is not just a commodity, it is a survival claim on the future. And when paper wealth becomes unstable, assets anchored to necessity become more valuable, not less. This is why farmland has behaved so differently from commercial real estate in periods of monetary stress. One depends on the stability of a leasing and financing system. The other depends on the perpetual truth that living bodies still need energy in edible form. That is a much stronger foundation. Now we come to the fourth mechanism. I call it curated scarcity. This one makes many people uncomfortable because it sounds frivolous on the surface. Fine art, rare objects, private sales, cultural assets. The public hears those words and imagines vanity. Sometimes vanity is involved, but the upper tier of that world is not mainly about decoration. It is about scarcity that cannot be printed and supply that cannot be reproduced. That is curated scarcity. A museum-grade painting by a dead artist is not simply an aesthetic statement. It is fixed supply. No central bank can issue more of it. No corporate management team can dilute it. No production line can suddenly expand output in a world where financial assets can be multiplied by leverage, policy, and issuance. Something with permanently fixed supply becomes attractive for a reason deeper than taste. It becomes a refuge for capital that wants to step outside correlation. And because this market often operates through private treaty sales rather than public auctions, it adds another layer of advantage. During periods of stress, sellers needing liquidity accept prices and structures that do not appear cleanly in public benchmarks. The buyer acquires the asset quietly, often at a discount the outside world never sees. That opacity is not incidental. It is part of the utility. The ordinary investor hears art and thinks status. The sophisticated allocator hears art and sees non-correlated preservation under a veil of cultural legitimacy. That is the actual mechanism. Now, let us move to the fifth mechanism. I call it essential monopoly. This is where the cycle stops being defensive and becomes offensively profitable, because the first four assets are largely about protecting capital and setting the table. The fifth is about building new fortunes when everyone else is still talking about risk reduction. Essential service monopolies are one of the oldest and least glamorous engines of crisis wealth creation. Waste hauling, storage, funeral services, water, medical waste, pest control. Other sectors the public barely notices because they are too ordinary to inspire stories. That ordinariness is the edge. People do not stop producing garbage during a recession. They do not stop needing storage when they downsize. They do not stop dying because GDP contracted. They do not stop needing water because the Nasdaq repriced. These businesses continue collecting cash through pain, that is, essential monopoly. And here is what makes them extraordinary in the aftermath of a crash. In good times, nobody wants to talk about them because the cultural premium belongs to glamour. In bad times, that glamour collapses. Financing dries up. Smaller operators fail. Routes, contracts, equipment, customer books, and regional market share get acquired at prices that would have been impossible, when everybody still wanted software, narratives, and optionality. The buyer who steps into those unglamorous assets after a downturn is not merely preserving wealth. He is institutionalizing cash flow. That is how fortunes are built in the dull corners of the economy, while the public remains hypnotized by the loud ones. Now let us move to the sixth mechanism. I call it crisis conversion. Every major crash creates the same broad opportunity, but the instrument varies. What matters is understanding the conversion process. Crashes convert panic into price dislocation. Price dislocation converts strong balance sheets into bargaining power. Bargaining power converts preparedness into ownership, that is the chain. The middle class usually experiences a crash as a period of involuntary passivity. Accounts fall. Credit tightens. Jobs feel less certain. Decisions shrink. Wealthier, better positioned actors experience the same crash as a period of strategic conversion. They take liquid assets, legal claims, and durable balance sheets and convert them into real ownership of assets that are suddenly mispriced. That is what makes a crash such a lopsided event. It is not merely a downturn. It is a sorting mechanism. People who prepared get options. People who did not lose them. This is why I reject the lazy language that says crashes simply destroy wealth. They destroy certain forms of wealth. They also create channels through which wealth is concentrated into stronger hands. Once you see that, you stop asking only how to survive the next downturn and start asking which structures actually gain power because the downturn happened. That is the more sophisticated question. Now let me take you to the seventh mechanism. I call it boring power. A lot of the wealthiest crisis buyers do not look smarter than the crowd at the point of entry. In fact, they often look embarrassingly dull. Treasury bills, farmland, senior debt, sanitation routes, utility, like services, museum, grade objects. None of these sound like the path to fast riches. That is precisely why they work. Because boring power is usually under-owned during boom times. Nobody wants to brag about cash. Nobody builds a cult around short paper. Nobody goes on television to announce they bought a regional waste contract business with pricing power and low churn. Nobody becomes a social media star for preferring legal priority over equity romance. That is why these assets arrive at the crash underpriced in cultural terms and often underappreciated in financial terms. Then the regime shifts. Suddenly liquidity matters. Suddenly survival matters. Suddenly replacement cost matters. Suddenly monopoly routes and fixed supply and creditor status and food producing land and cash in the account all become obviously precious. And by then, the people already there own the board. That is boring power. Now I want to force the identity shift because without it, you will keep hearing this as a clever list instead of a real operating philosophy. Stop thinking like a crash survivor. Start thinking like a prepositioned acquirer. A crash survivor asks, how do I lose less? A prepositioned acquirer asks, what ownership mechanisms become more powerful when everyone else loses room? A survivor sees cash as missed return. An acquirer sees cash as future command. A survivor sees bankruptcy as failure. An acquirer sees debt priority as a transfer channel. A survivor sees farmland, waste management, storage, and art as random asset classes. An acquirer sees scarcity, necessity, legal rank, and monopoly cash flow. That is the stronger identity, because wealth at the highest levels is not built merely by being right about markets. It is built by understanding what the market becomes when fear strips away the luxury of pretending. Now let me give you the operating system. First, Treat liquidity as ammunition, not laziness. The person with cash when assets break is not behind. He is armed. Second, learn the capital structure. Equity is the loudest claim and often the weakest one. Legal priority matters more in a real crisis than narratives ever do. Third, seek assets anchored to necessity. Productive land and essential services survive because biology and daily life do not honor the market's emotional schedule. Fourth, respect scarcity that cannot be printed or replicated. Some forms of preservation hide inside objects the public dismisses as luxury. Fifth, remember that the best crisis businesses are often boring before the crisis. That is why they can be bought before glamour returns to them. Sixth, understand that crashes are transfer events. Ask what is being transferred, to whom, and by what mechanism. Seventh, prepare before the panic. Once the headlines turn theatrical, the best terms are already being negotiated by people who spent the prior years looking patient and a little unfashionable. That is the heart of it. The rich do not buy magic. They buy position, they buy time before the crisis, they buy seniority before the restructuring, they buy caloric land before paper weakens, they buy cultural scarcity before money needs somewhere non-correlated to hide, they buy essential cash flow before the economy rediscovers that boring monopolies still collect when dreams stop paying. That is not conspiracy. That is pattern recognition applied with discipline. Now, let me end where this really matters. You can keep believing crashes are just storms to endure. You can keep thinking the best you can do is diversify broadly, stay calm, and hope your allocation gets you through. You can keep treating liquidity as drag, boring assets as irrelevant, legal structure as a technicality, and necessity businesses as beneath your attention. Or you can do the harder thing. You can admit that every major downturn is also a shopping event for prepared capital. You can ask yourself whether you are set up to be forced into passivity or positioned for acquisition. You can start thinking about your portfolio not just as a basket of returns, but as a hierarchy of claims, options, and capacities that will either expand or shrink when the next stress event arrives. That is the threshold. Because when the crash comes, the market will not ask whether you were morally against panic. It will ask what you own, what you can buy, what legal rank you sit in, and whether your capital can still move while other people's cannot. That is the mirror. Look into it carefully. The next downturn will not simply reveal what went wrong. It will reveal who prepared in a way that turns collapse into transfer, and those people will not look like prophets. They will look like they were boring early, which is often the first sign that they were right.